Is the last webinar on this topic by Syed, and also happens to be my last webinar as the president of AAPI, as far as webinars are concerned. So next time you won't be seeing the background I have, the virtual background. I'll be a civilian from now onwards after July 9th. Again, thank you so much for all your support the year long, and it has been a fantastic time and journey I had. I learned a lot and I have grown a lot over the past year. I've become more mellow and wise and calm and gentle, I would say. And I think my wife will watch for that. Anyway, so again, welcome to our AAPI's financial education webinar on estate planning and tax saving strategies for the physicians especially. Yours truly, Ravi Kolli, hosting the event for the last time this year under my term. And this is an educational webinar, and so attendees and all the members should consult their own financial advisors and attorneys for any real life and real-time decision they want to make. This is the fourth webinar in this series, hosted and along with me by Mr. Syed, Nishat, our good friend, and he has been a long time friend of AAPI, and he has been very supportive this year entire time. And he's also supporting our convention in July in Philadelphia. So please do come there. He has some presentations there as well. And last time we talked about estate planning, asset protection. Primarily, we talked about investment planning last time, management. This time, we'll talk about tax planning and estate planning as well. What we have done today is to put a few questions together, and I will ask them. These are some of them from the previous webinar. And it's not going to be a long and boring presentation. Syed always makes it very kind of crisp and very humorous and very timely and very precise. So you'll enjoy his presentation. He doesn't push any products or any services, hard sells. He just educates you, and he believes the best consumer is the educated consumer. So I'll ask questions to Syed and he will answer. And you can also ask your questions in the chat box. And so please type your questions in the chat box and we will try to get them all answered today. Just a brief intro. Syed is a financial advisor, not just a financial advisor. He's a fiduciary financial advisor, which is a higher responsibility. It's like almost like a board certified physician versus just a general physician who's not board certified, I would say. If I'm wrong in stating that, correct me, Syed. And he's a partner at the Wall Street Alliance Group. And his articles and interviews have been featured in many media outlets on asset protection and common financial mistakes by physicians in MedPage Today, Medscape, also regularly quoted on the Forbes magazine, Kevin MD, US News, Investment News, and Yahoo Finance. So let's get started. Let me start asking some really tough questions. Syed, you have some really tough questions coming your way today. Okay?
I'm looking forward to it.
All right. Okay, without sounding like a lawyer or a financial planner, can you explain to me what does it mean when you speak about estate planning? What are the components of it? At what age should I start planning for that? Am I too young? Am I too old? Or in between? So tell me at what age physicians should talk or think about estate planning.
Yeah, thank you again, Dr. Kolli, for inviting me, and I'll definitely miss you. In the upcoming webinar, and you did a wonderful job for the AAPI community. So one of the questions people ask a lot of time, tell me the basic of estate planning, and also what are the components and what age I think about. So I answered this question before, answering again is one of the frequently asked question. Age doesn't matter. What matters is what is your net worth. If you have a lot of real estate, if you have retirement account, usually we would like to see once you cross your net worth over $1 million, you should get some basic estate planning done. What are the components? There are mainly three components. Will, basic will basically designate what will happen to you in an event, to the children, and who gets what according to your wishes. That's what will means. Second, living will. While you're alive, like one of my best client, Texas, got COVID. He was bedridden. The wife had power of attorney. She was able to call on his behalf and make the decision for the business. So you need to have the power of attorney and health proxy as well. Now, one thing people make mistake is they only have a will. Now, if you just have one retirement account and one house, fine, will may be okay. But most of the time, physicians are high net worth. They have other properties beside just an account. They have multiple real estate. They have investment outside of different states or multiple assets. So that's why we recommend have a revocable trust as well. What trust basically does is a private document. Will is a public document. Trust is a private document. What trust does basically, it makes sure if anything happens, nothing goes to court. You create the trust, you put the house, you put the retirement account, you move everything under the name of the trust. So in this way, there's no probate, nothing to worry about. And one of the biggest benefit of trust is, which I highly recommend for physicians to do, revocable trust, is like tomorrow you pass away, the children get married, get into a divorce or lawsuit, all the assets are protected because the trust becomes irrevocable at that time. So it is not just avoiding probate, it's also for the purpose of divorce protection and asset protection for the children as well. So just to summarize, I know you told me not to talk like a lawyer, but I cannot avoid it. I have to talk like a lawyer. So you need to have a will, you need to have a power of attorney, health proxy, and a revocable trust and fund it as well. That's it. That's the ABC of financial planning. Hopefully it makes a little sense.
So once you have this trust, and when you pass away, your children get the trust, the beneficiaries, and if they get divorced, there is some protection that the
Correct.
that they don't lose the access to those, complete access to those funds.
Absolutely.
Okay. So you spoke about the trust. So what is the difference between the revocable and irrevocable trust? And if you have a trust, do you still need a will? I think you alluded to that, but tell me again.
Yeah. So people ask the question, what is revocable now? What is irrevocable? Attorney language. Simple language, revocable means you can create it and you can dismantle it anytime without any problem. That's revocable. You can revoke it. Irrevocable is basically once you create it, you cannot change nothing. Irrevocable, the main purpose is gifting purpose usually. You gift to the children, but what's the best way to gift it? The best way to gift it is through irrevocable trust. That's for gifting and asset protection purpose. Revocable is for while you're alive, you pass away to avoid probate. Do we need both? Depending on your net worth, but the starting point is a revocable trust. Do we need a will as well? Yes, because not everyone can be titled under the name of the trust. Like the car, Dr. Kolli, you drive cannot be under the name of the trust. Your wife, I'm assuming, have a lot of jewelries. That cannot be under the name of the trust. It just spells out in the will what happened. So that's why you need to have a will as well. But the will becomes simple once you have a trust.
Okay. So the asset that cannot be protected under trust can be protected or at least distributed under the will.
Correct.
And you, okay, very good. So now I have irrevocable trust. Do I need a revocable trust as well?
Yeah, so a lot of people ask, a physician asks, hey, my attorney suggested for asset protection to do irrevocable trust. Do I need a revocable as well? So remember, it's a quiz for you, Dr. Kolli now. Let me see if you understood. Revocable, what's the use? For gifting, right?
Mm-hmm.
And irrevocable, I'm sorry. And revocable to avoid probate. So whatever you gifted, it's no probate, but whatever you have left over will be probate, right? So what do? Revocable trust. So that's why you need to have a revocable trust as well, whichever you have not gifted. So that's why if you have an irrevocable trust for gifting, but then whatever the assets to avoid probate, you have a revocable trust as well. Hopefully kind of makes sense.
So the revocable trust is almost like a will?
It's almost like a will, correct. And it's a private document. Will is a public document. So it's funded. So in this way, no probate, nothing.
Okay. So you're avoiding the private,
Correct.
public documentation.
Correct.
Okay, very good. So what are the common mistakes physicians make, which we don't like to admit anyway, when we create a will or a trust, will and trust?
Yeah, I've been doing it for 17 years. Three major mistakes, we see in the will, so and a trust. So if anything happens to husband, wife, they give it outright under the name of the children. Like my two sons, Aya and Noah, if I pass, they get it. My wife and I pass away. It's a mistake because they get it under their name. And what if divorce happen? Assets become split, if they commingle the money. Number two, what if they will start buying a Maserati? So obviously these are the things. So you want to like create a separate trust for them. You spell out in the trust that if anything happens to both of you, they will create their own trust and transfer money, and you put some provisions there. So don't exactly give 100% under their name. It will be under their separate trust, number one. Number two, you have to move everything. So remember, we want to avoid probate, right? But if you just have a will, and you have a trust, but you have not moved everything. Like the house should be under the name of the trust, the retirement account beneficiary should be the trust, brokerage account under the name of the trust. If you don't move it, it's a fancy document. You paid the attorney for nothing. So it will still go to the probate. So make sure you move everything under the name of the trust as well. And lastly, I see a mistake people make. They move from one state to another, especially retiree. Like New York, they go to Florida a lot, I see. And the trust is very old. So if you move from New York, you had New York statute when you created. Now you move to, by the way, Florida. Incorporate the Florida statute as well. So make sure you revisit as well. So these are the three mistakes we see all the time.
Okay. So that's good. Thank you. How often we should update will and trust? You kind of made a comment about when we move from state to state, and how much does it cost for the basic will and trust? I know there are a lot of variables in that question, basic cost versus like more complicated trust and will.
Yeah, so we're talking about basic, though, okay? Don't quote me on it. We're just talking about basic will, revocable trust, power of attorney, health proxies. Around, I have seen most of the time, it's about close to $3,000, $3,000 to $3,500. So that's why that's what basically how much it cost. And then the will, trust, everything included, 3,000 to 35. There should be some additional fees when you move it, like the deed of trust. You go to the county. Those other stuffs are there as well. But usually $3,500 all done.
Okay. So it seemed like in the USA I had to pay taxes while I'm alive and also after I'm dead, which is called death tax. Well, is the same as the estate tax? How does that work? Is what is the best time to die when?
Yeah, I mean, people say that if I die, my net worth is large. If I die right now, no estate taxes. I mean, high net worth, net worth is, yeah. So in America, there's a income tax, there's a death tax, or which is called estate tax. So as of right now, if you look at the screen, so as of right now, 2022, 2023, anything up to 24 million, 12 million each, ballpark. Husband, wife both dies, no estate taxes. Very simple. But the one problem is expiring in 2025. In 2 more years, it's coming down to 6 million each, which is 12 million. So if your net worth is quite substantial, like big celebrities and stuff, then some planning should be done. So we can talk about it. What are the strategies? But again, if your net worth is more than 12 million after the year 2025, we have to worry about paying state taxes.
That they can't join for some reason, but anyway, so the exemption from death tax is going to die soon, I guess, right?
Correct.
So from being kind of fairly rich to mediocre rich, the tax brackets are going to change, and the estate tax brackets.
Correct.
From 12 million to 6 million. So thank God I'm not in the both brackets anyway. Long way to go. All right.
Yeah.
Coming to that point, for those of you who are high net worth, which is not me, probably you are, and my financial planner is definitely, most lawyers are, and most accountants are. So what are the strategies now to lower the estate tax?
Yeah, a few things. I'm not going to go through all of it. One option, remember at the beginning, you spoke about irrevocable trust. You can gift it in an irrevocable trust. once you give the money through an irrevocable trust, you can get right now almost 22 to 24 million out of your state. So keep some money for yourself, gift it. And whatever you gifted, the money goes to state tax-free. Don't have to worry about it. Every year, $16,000 to $17,000 you can gift it. You don't have to worry about filing any gift taxes, and all money is, out of your state as well. You can buy some life insurance, second to die life insurance. But remember, there's no estate tax after husband wife both dies. So you can buy like a cheap second to die policy, and the money is out of your state. Life insurance, it's a huge life insurance, if you have it, that is part of your state. There's no income tax, but there's a state tax though if the total amount, including life insurance, proceed more than 22 million, right? So you can move the life insurance out of your state after 3 years. The money is completely, out of your state. So, and lastly, you can do charitable planning, which I'm not going to cover detail, but let's say I'm giving an example, Dr. Kolli, your net worth is 50 million. I'm just giving an example. 24 million, you keep it for yourself, no estate taxes. The difference of 26 million, you give it to AAPI after you pass away, husband, wife. And this money will be completely no taxes because it goes to charity. But now you can create some sort of charitable foundation. The children could be the trustee, and you can do something called charitable lead trust, charitable remainder trust. The money goes back to the family eventually. So this is completely outside of today's presentation, the scope, but a lot of advanced planning you can do if your net worth is more than 24 million.
Yeah, my estate was worth 50 million, but not the dollar figure, but maybe rupees or rubles or something like that.
Yeah.
Anyway. Okay, so gifting you mentioned. What is the best way to gift children without they kicking me out? You said 16,000, that is under 18 or even above age 18, you can give without paying taxes for them not paying taxes? What is the?
Well, you can just give 17 to 18,000, 16 to 17,000 every year. No basically gift tax requiring done. That's on top of 22 million you can gift. All right. But I'm saying that I think you're asking that what's the best way to gift them, your states and everything without, losing control. Let's say you give your house, they own the house now out of your state. What if they kick you out of the house? I guess that's what your question is.
Yeah, how do you protect yourself while you're alive when you gift them to the whatever assets you want to gift them, including your house or whatever?
Yeah. So someone raised the hand, but let me just answer the question. The best way to gift it is through SLAT. If your net worth is more than 24 million and the exemption is going down, spousal lifetime access trust. It is an irrevocable trust. You can gift the money is out of your state, but once you actually gift it, as long as one of the spouse is alive, you have full control over it. And then one spouse can take it and give it to the other spouse. So again, it's called SLAT, spousal lifetime access trust. Is an irrevocable trust. It gives you the capacity to control the estate that you have gifted to your children and use it for yourself as long as the other spouse is alive. So this is one of the best way of doing it.
So if you want to avoid paying taxes, probably it looks like you have to pay your accountant, your financial planner, your attorneys to make them rich instead of paying your taxes. So tell me what is the bottom line about all this?
Yeah, now you're asking for the bottom line. But it does actually save you some taxes though, Dr. Kolli. I mean, just want to show you one example. Let's say your net worth is 25 million, which you have denied, but let's say it is 25 million. You pass away.
Dollars, not dollars.
Right. The 25 million under the current law, and let's say you have a $4 million life insurance policy. I'm just talking about term life, 25 million net worth. According to the current law, about 3.5 million estate taxes due, but in 2025 it expires, 8 million estate taxes due. I'm just giving you an example. Someone is high net worth. You do simple math. You gift from I go back from the 25 million, 13 million you gifted through SLAT. this 4 million life insurance, you move it to the life insurance trust, remember, out of your state. Now you pass away in 2025. Remember, all the money completely out of your state. There's no estate taxes due, nothing, because you already have gifted it, if the law even goes down. So a saving of almost 8.5 million. So now I know that the lawyer and everyone you have to pay, but if you save 8.5 million state taxes, pay the lawyer a little bit. But yeah, so the question becomes, how much is the cost? Remember, revocable trust and everything, and and the power of attorney, held proxy, it cost about close to $3,500. But then if you create this slat, there's additional $4,000 on top of it. So each time I say trust, 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 you're talking about a few $1,000s.
There are a lot of questions. 152 people are here, and a Wednesday night is a really testimonial to your popularity in our AAPI community, Syed. And
Sure.
you have proven yourself to be a rock star of financial advisors for us.
Thank you.
Let me ask the question that Dr. Vidya Kora raised the hand, and I'm not sure whether we can unmute him. Let me ask some questions, and then we can answer Dr. Kora. How do I include real estate in India in a trust in USA? Do I
You
need a
can't.
separate-
Yeah, unfortunately, you can. You just have to go the create a will there. My clients in India ask the same question. You can. The will and trust is valid only in US.
Right. India wants their taxes. You're not going to escape their tax
Yeah.
by having a trust. And my good friend, Dr. Praful Bhatt from Penn State area, at the end of 2025, how likely is that estate limits could be changed?
Yeah.
Okay, go ahead.
Yeah. My answer will be as good as like flipping a coin. I would not know it, but why taking a chance if your net worth is that high? If your net worth is that high, might as well gift it. But remember, in SLAT, you can just use the money for yourself as long as one of the spouses is alive. So if your net worth is substantial, my suggestion is to gift it. Don't wait, don't gamble.
Who's in charge of the Congress? Who is running
Correct.
the House? Okay, how good is the TOD account? And can you bypass irrevocable trust only with the TOD and prober beneficiaries in your will, Dr. Manoj Kumar? Or I don't know what TOD is. Let's just tell what TOD and then go ahead and answer that.
Yeah, TOD means transfer on death.
Okay.
That's called TOD. So remember, I think logically, the answer will be very simple. You have an account with Fidelity, you have a TOD, and you put the irrevocable trust. It doesn't work this way that you pass away, the TOD, they just release the money. They still need some sort of court order to release the fund. It is better to have an irrevocable trust and have a TOD versus like nothing. But the best way to handle it, as I mentioned, if you have a substantial net worth, after you have gifted to an irrevocable trust, create a revocable trust as well. If you get a good package deal with an attorney, they will not charge you much because you're doing so many things. And you fund the revocable trust as well. Don't have TOD, have a revocable trust, own it. The benefit is that after you pass away, this revocable trust will become irrevocable automatically, similar to the irrevocable trust you have it. You can just merge it together. That's the right way of doing it. Now the question is, what are the chances of probate? It is easier if you just have a TOD and irrevocable trust versus you don't have nothing at all. But yes, to answer your question, how complicated it is depending on the state you live in. New York, New Jersey is getting easier.
Finally, New York. That's great. And Mini Sharma, thank you for joining the club. People who are less than 12 millions. I'm safe too. So next question, my good friend, Dr. Bhatt again. Is it true that you should list revocable trust as a beneficiary for most assets that do not have beneficiary designations?
Yeah, so the retirement account, the primary beneficiary should be the spouse. Secondary beneficiary should be the revocable trust. And the rest of it, either it is title, it is owned by the revocable trust, or it is the beneficiary who's a revocable trust, like the life insurance. So yes, it should be.
Okay. Next question probably needs some explanation. Can you fund their IRA, Dr. Malhotra, meaning your children's IRA? What are you talking about here? Do you have any idea what?
Can you fund the IRA as a gift? You cannot. The IRA, remember, is your money. It will be passed to the children after you pass away.
Right.
So only real estate, cash, properties, those could be funded.
Sorry, my Amazon kicked in music for some reason here. Can you guys hear it? Amazon, turn off the music. I'm sorry. What is it? Amazon is what? Okay. When you gift 16K per year to your children, do they have to pay income taxes? I think that was one of my question I kind of alluded to.
Yeah, so if you give 16,000, there's no gift tax, but if there's any income after a certain amount and stuff, there
That's
is.
a ton of music.
Yeah.
Hello, can you hear me?
Yes.
Okay. All right, go ahead.
Yeah, 17,000 you can gift every year. There is no gift tax filing, but any capital gain happen, obviously, after a certain amount, like there's something called, the laws that are kitty tax and stuff like that you have to worry about. So they do have to worry about paying taxes, depending on the income, they have to pay taxes, obviously, on the income tax. That's something you cannot avoid. The gift tax, you don't have to worry about it.
Right. Probably you're better off giving your grandchildren who probably are not paying any taxes, the more money, right? The 16.
Any income they do, the children have to pay taxes, correct? After, even if you gift it.
But if you give the grandchildren like teenagers or under teenagers,
it will be lower, but obviously, then remember there's a threshold, right? After this amount of income, no taxes, capital gain up to this amount, no taxes. So it will be hard to answer it, but depending on the income taxes will be there for the children.
right? I have a question here. If your grandchildren are dependent on their parents and they're claimed as they're dependent by the parent, when you give the tax money to them, do they declare it as a parent's income or it becomes their income, or what happens?
Yeah, so what happened once you gift it, the money is under their name, right? So obviously no gift tax is due. That's just simple. But now they invest the money into some mutual funds, some stocks I'm talking about. So that gain happen, there's certain amount they pay taxes on their tax rate, but IRS is laws are very smart. So if the income goes after a certain amount, it is taxed under the parent's tax rate. So so it depends on how much is the income.
Okay, very good. So Dr. Kaur asked that question. Dr. Satya Reddy, can you focus more on the typical physician with 5 to 8 millions in total net worth? That's a good question. Probably that's where most of us are, other than the high-flying specialists like cardiologists, gastroenterologists, oncologists, and orthopedic surgeons, cosmetic surgeons, and all those. So general people like me, psychiatrists, primary care, pediatricians, primary internists, 5 to 8 million probably is a more realistic, reasonable, aspirational goal we all have. How do we kind of protect those assets?
Yeah, so for clients like this, if your net worth, so that's why I said don't overcomplicate it. We see lawyers coming all the time and say, hey, this thing happening, that thing happening, nothing is happening. Even the law changes, remember, it will most likely will go back down to 12 to 15 million. So if your net worth right now is about, close to $5 to $6 million, you should be most likely fine. Focus is just to get the basic estate planning done, will, revocable trust, and fund everything. Don't overcomplicate stuff. If your net worth, let's say you win a lottery, then if your net worth goes higher, then we can think about it, sit down at that time.
Yeah, I think I like you said, even if the death tax comes down to 6 million and a couple 12 millions, we still probably most 90% of us are not, or 99% of us are not going to be in that bracket. Right. Okay, Dr. Butt. Again, you recommended irrevocable trust, but you're essentially giving away assets and can't use those assets or income they produce Irrevocable trust, I'm not sure. Okay, you should place money you know you would not need in that, I guess. Most of us would not have access to put away in irrevocable trust. Okay, go ahead, answer that question.
Yeah, you recommend an irrevocable living trust, but you are essentially giving away. Yes, we are essentially giving away. So that's why I am only recommending that the money you don't need, only that portion you just give it away.
Right.
Your net worth should be at least north of. We would like to see 20 million to do all of the planning. If not, then why would you want to give it away? You want to use it for yourself.
Right. I think again, the similar Dr. Malhotra again, I think he explained, can you fund the children's IRA as a gift? I think he mentioned it, but now he's explaining. Can you fund your children's IRA? I guess retirement there, like, can you start a retirement account for your children?
Yes, you can fund the children's retirement account as long as the children has earned income. You can open up IRA account for them. We recommend Roth IRA because they're in a low tax bracket. They qualify, money growth tax free. Withdrawal is also tax free, and they can use after 5 years, college fee, buying first time house. Absolutely, if you can do it.
Okay, good. So Roth IRA, you put the post tax money, so it will the returns will
Correct.
be tax free. Okay. So what kind of planning, Dr. Geeta Patel, planning should one do for assets under 5 millions? I think
Similar, what we answered.
Yeah, we don't have much to do except invest them properly and keep it growing and
Absolutely.
And then you might need that trust. So Dr. VM Patel, what happens to the assets which are not in the irrevocable trust? Dr. Vinod Patel.
Yeah, so the assets that are not in a revocable trust, they will go through a small probate process. So that's the whole purpose of revocable trust, is to avoid probate as much as you can. So retirement account, what happened that it will go through a little bit of a probate process. So that's why fund as much as you can. The rest of it, unfortunately, will go through a little bit of a probate depending on the state you live in.
Okay. So next question is interesting. Dr. Pinakin Patel, IRS code for trusts is the same regardless of state you live in? I guess IRS is in federal tax code. So tell me what's your take on that?
Yeah, the IRS code for the trust is the same regardless of this. Yes, the code is the same you live in, but I'm just talking about the statute for that particular state that you're moving. So we would like to put the statute there once you move from one state to another state. It's a simple two-page document. New York had their own statute. Florida has their own statute. Just incorporate. Once you move it, just make sure just update that last page. It doesn't cost more than $250. Just get it done.
Okay. Dr. Arakpudi, Smita Arakpudi, don't your should be suggestion actually depend on one's intent and wishes? Okay, I don't know what Dr. Arakpudi meant. Don't your should be quote unquote suggestions be dependent on one's intent and wishes? Obviously, but go ahead and answer that interesting question.
Who is this? I cannot see the question.
Dr. Arakpudi, the question on the top.
Don't you should be suggesting actually depending on one's intent and wishes? Yes, there should be suggestion actually depending on one's intent and wishes as well. And you need to sit down with your financial advisor. We are just talking about how it should be, but that's why at the beginning you mentioned sit down with your financial advisor. We are giving all the information possible, but the actual implementation should be done with your financial advisor.
Well, should you identify the age, example, 25 years, 35 years, in your trust that your children should get 25% at the age of 25 years, then additional 30% at age of 25?
We do that. Usually we see 25, 35 years. The reason is because the children becomes more mature as they become older, so they put these clauses there, correct?
Some control at what age they can
what age,
take it over. But there's any end point where you can't control anymore?
You can go as, how much you can control, right? You can go but by the time if the children are 45 is still not mature, you have a bad luck. So, only so much you can control.
But they got your genes, you can't blame them for that.
I hope my children are a little smart, yeah, let's see.
Yeah. And is trust document registered in a county office like a Connecticut? CT means, I don't know, Connecticut? Not
No, it's not a county office. You have to register it. You have to register the deed under the name of the trust. We have to move it. Yes, the deed needs to be moved.
All retirement accounts, annuities, life in Dr. Praful is a very good student. He asked a lot of questions. All retirement accounts, annuities, life insurance policies, all these assets outside are probate even without the use of trust. So why do you go to the trouble of putting them through revocable trust?
Yeah.
So again, a good question for those people who have more than 12 million, 24 million, this question, I guess. Go ahead.
Yeah, exactly. He's right, though. So all these assets outside probate, even without the use of trust, why go through it? But remember, the benefit of a trust is not just a probate. The benefit of the trust is you put provisions there if anything happens to both of you. The children create their own irrevocable trust. You put it's called lifetime trust, and then transfer money. If you don't have the trust, the children can easily commingle the money they inherit as a beneficiary, and then commingle with the spouse's funds, and is part of the divorce proceeding. So that's why it's important that you put the revocable trust, put all the provisions there, and it is not just a probate. It is more of a divorce and asset protection for the children as well. That's extremely important.
Can you pay their mortgage and student loan, etc.? I guess for the children,
You can.
Yes, you can, but does it come out of a gift, right? As a gift tax or some gift?
Yeah, so you can, if you have transferred it from there, you can. If you haven't transferred it, obviously any money more than 17,000 you use for them. I'm just talking about for you to give them as a gift. You have to file for gift taxes.
The best way to pay their student loans.
Yeah.
Okay. Dr. Omar, does the recipient of the gift tax have to report the gift to the IRS? Yes.
Yes.
Okay, simple. So I think you're making a good financial advisor as well, Syed, with all your training. And can you give the child 16K in the form of paying their tuition? I think similar question, Dr. Kota, or will be, anything you give the under 16K, they don't get taxed, but
yeah, so the question, if you just pay their tuition and everything, this is their living expenses, nothing to worry about. But we're talking about giving under their name, like, from your name to goes to their name, anything more than 17,000, you have to worry about filing gift tax. There's no gift tax due, but you do have to. Just file it.
To worry about it. After up to 16, you can give them without any gift tax.
Correct.
Right? Right.
Yeah. So remember, there's no gift tax, it's just a gift tax filing due if the money is more than $17,000 gifting it.
But you're paying the tuitions to the school directly. They don't pay tax.
No, not at all.
Do they have to declare it as income though?
Not at all. They're dependent.
Okay. What about if they're not dependent? If you're paying the non-dependent child some tuition assistance, paying their tuition, do they have to?
If you're just assisting them, nothing to worry about. That's fine. It's just like under their name, they get it from your account to their account. Only then you do have to worry about it. How
about setting up transfer to asset directly to grandchildren bypassing the children? Is that through a revocable trust?
Yeah, so if you want, you can just give directly to grandchildren, but again, same rule apply. More than $17,000, you do have to worry about it, whoever you want to gift it to. But the grandchildren, you can create some sort of dynasty trust as well if you want to gift it. But remember, you can do like a nomination, like for example, if a retirement account, you can just change the beneficiary to the children, and the grandchildren, that should do the same trick as well. So that's fine.
Already wants to ask a question. Let me see if I am able to unmute anybody. Let me come to that later. And
there's so many questions, I guess won't be able to finish it. Do you want to go to the other topic, you think?
Yeah, let's go to the next topic, and if we, depending on the time factor, we can address it. And now coming to the tax planning, which we all hate doing, and any suggestion how to pay zero tax, like Bezos or Buffett or Elon or a Trump guy do that? How do you pay no taxes and then still complain and whine about paying taxes?
Yeah, I mean, there's nothing called, zero tax. I'm not sure about it, but we can give you some strategies. Because remember, once the 2023 December is over, there's only so much you can do in terms of the tax filing. So what are the things you can do? So if you're self-employed, I will go through the list fairly quickly. So New York, New Jersey, California, Georgia, depending on the state you live in, they pass a law when Trump became president. When you pay the estate taxes and the property tax, the maximum deduction is 10,000. New York, New Jersey, Georgia recently, last 2 years, passed a law. If you just pay the same state tax from the corporation, you get the full tax deduction federally. It's not automatic. It depends. So you have to select it to pay for it. So again, speak to your CPA before December, pay the state tax from the corporation. It needs to be done before the year end. Number two, a lot of physicians invest into real estate. In the real estate, as you know, there's something called depreciation, meaning the depreciation you can get to write off from the rental income you collect. You can do the cost segregation study, lower the depreciation from 15 years to all the way 2 years if you want to. So by December, you should do a cost segregation so to have a higher depreciation if you need it. Number three, if you need a bigger vehicle, if the vehicle weighs more than 6,000 pounds, you buy it before December. If you own the car before that, self-employed, you can write off the full purchase price of the car from the corporation. Again, this needs to be done by December. What other things needs to be done before December? If you're charity-minded, give donation before December. A lot of people give cash. Don't give cash if you have stock account. If the stock is high, donate that into some sort of donor fund. The benefit is an appreciation, no taxes either. Few more. If some stocks are down right now, like DocuSign or Teladoc, people buy stock like that. If you want to sell it, go ahead and sell it, because the loss can be written off up to $3,000, but in the future, the loss can carry forward as well. Max out the employer 401k 457, because before December, whatever you can, you have to do it. If you want to open up a defined benefit plan, we recommend doing it at the before December end, because defined benefit, Dr. Kolli, is based on your wage and age. If your wage is lower, the contribution is lower as well. So ideally, we should adjust all of it, the calculations before December as well. If you want to open a 529 account and contribute before December 31st, you should do it, because you have a state tax deduction. Like New York, you have a $10,000 state tax. Again, before December, you have to do it. Roth conversion for this year, if you want to convert it before December, you should convert it. The benefit of Roth conversion is the money grows tax-free when the money is in a Roth. Few more things very quickly. If you invest into opportunity zone is going away in few years, but if you invest into opportunity zone means where there's an area, there's a 20% property rate. If you hold the property for 10 years, there's no taxes on the gain. Again, very powerful. And last two things, a lot of physicians kind of missing out. If you're self-employed, you qualify for something called QBI, Qualified Business Income Deduction, if your income is below $315,000. A lot of physicians think I don't qualify. It's a mistake. If your income is below 315, self-employed, you write off 20% of the business as a deduction. So it is true for people who are close to retirement. Like say, I have a physician who sold their practice, but now just getting some locum 1099. So so before December, show some expenses like defined benefit plan, charity. So the income is below 315, so you can get QBI 20% of the income as a write-off as well. And lastly, a lot of physicians miss out that if you have rental income, like if you have a rent, second house, you're renting it, or if you have some real estate, commercial, residential, the rental income you collect, you can write off 20% as a rent as a deduction as well, called QBI. A lot of physicians kind of miss out. Ideally, the property should be into LLC as well. So again, these are some of the pointers. I know you asked one simple question. I actually give you 17 pointers, but the recording will be there. The audience can take a picture of it, show it to their accountant. Hopefully, some of the pointers will be kind of clicker for them.
The past president, being a past president, he has the privilege to ask a question directly. I'm going to allow him to talk, okay?
Yeah.
Go ahead, Dr. Rangareddy. Probably is up. Okay. Let me go to, when do children have to withdraw inherited IRA money?
Yeah, so that's one issue we spoke about it last webinar, that previously what happened, Dr. Kohli, that the children had their whole life. Like, let's say if anything happens to you, your wife, the children have their whole life slowly to withdraw the money. It's called RMD for beneficiary. The benefit is that you pay less taxes, but now it's going away due to Secure Act. Now the children have to exhaust the money within 10 years. So if you have, let's say, $5 million in the 401k, they have to take all 5 million in 10 years. Again, it's a big issue. So one of the solution is, we talk to a client, if you have grandchildren, give them the beneficiary of the retirement account, because the 10 years doesn't kick in unless the grandchildren is 21. So you can buy some time. So if you have a lot of money in the qualified plans, 401k, nowadays, because of Secure Act, they have to use it within 10 years. But if you have grandchildren, the 10-year doesn't kick in until the child is over 21. So you buy some time. So there's some planning can be done for that as well.
Okay. So shall I go to the audience questions, or you want me to?
We can talk some about taxes, some more
Right.
audience question before the last topic, which is investment.
Okay. So what idea should I take to my CPA? I think probably all of them, and let them pick what suits you, right?
Yeah, so I know that there's a lot of ideas, but the one pointed in bold, I think at least talk about it. These are more pressing because once these are like, good deductions to have it before December, you should implement it. And so until defined benefit, whatever the pointers are there, kind of sit down with your CPA and go through it if you can.
Okay, and let me ask Dr. Satya Reddy's question. I think probably she may have some information that I don't know regarding vehicle over 6K. The limit is 27,000 as of 2022 for section 179. Is that true?
No. So the law passed advanced depreciation. Previously, it used to be only 25,000. So now if the vehicle is more than 6,000 pounds, you can write off the full purchase price because of advanced depreciation. So again, very powerful, and most likely is going away. It's phasing out, is expiring in 2 years. So that's why I'm not saying go ahead and buy a Rolls Royce or anything. What I'm just saying that if you do need it from the business perspective, go ahead, do so.
Does any Tesla qualify for more than 6?
Model X qualifies for it.
Okay, good. All right. Let's talk about investment management. Now that market is going up and down, sideways, zigzag. I know you don't have a crystal ball and find out exactly what's going to happen in the next week, next month, next year. So what's your outlook? Let me still ask you that question, like everybody always asks at the cocktail party.
Yeah. So our outlook, that if you see that our last webinar, and also my partner, he goes to CNBC and we talk about the outlook. So we are very bullish about the market because the recession, if you see that, so the first question is, Dr. Kolli, where is the recession? Everyone's talking about recession. There's no recession, looks like. Everything is fine. The inflation rate is going down. The interest rate, although is going higher. So we haven't seen the recession yet. We believe that even the recession happens, it's going to be shallow recession, like it's going to be short term. So we are very bullish about the market. But the problem is the market went up too quickly. I don't know if you realize it, and NASDAQ is up 30% already. It's just June, and S&P is up quite a bit. So we are a little bit cautious right now because the market went up too quickly right now at this stage. So my suggestion will be to the audience that a lot of people, we are like heavily invested into technology last year. They most likely are down, but technology has gone back up. It's a good time to like kind of unwind it and make sure the portfolio is balanced properly. And I'm going to show you in a bit some of the techniques that the audience can use to kind of do investment by themselves.
Okay. It's always risky, but I know the market is a little frothy. I mean, some of these even mature companies like say Apple has a P of 28 and Microsoft. Do you think these are sustainable, or they're going to all regress to the mean again? It's pretty soon.
Yeah, the technology, I think, got a huge boost from the AI driven. It's right now all about AI. But we're not sure about Apple, how much it's going to benefit from AI, but definitely Google, Amazon, and Microsoft, they own, like, I would say, more than 30% of the AI. They will benefit a lot. The good thing about Apple is like it's a product driven, it's a cash, but as long as you don't have more than 2 to 3% of the portfolio into one stock like Apple, you're all okay. Problem I see, Dr. Kohli, that people put everything into Tesla, 50% in Tesla or Bitcoin. That is the problem. So you can own a diversified portfolio stock if you want to, as long as it's diversified is okay. Our recommendation is always for physicians who don't use financial advisor to buy passive management, like ETF. That's the way to go. But if you are like a great stock picker, like some of my clients are, as long as it's diversified, you should be okay.
Right. Some ETF like QQQ has done very well, I think.
Correct.
34. All right. So I don't want to use financial. I want to do it myself. What is your starting point?
So just in case, if you don't want to pay financial advisor fees, I understand all of it. A typical model looks like this, Dr. Kohli. There's no other way to, there's nothing called crystal ball. There's nothing called magic. I have it or you have it, anyone has it. A conservative portfolio is 50% cash kind of investment and 50% equity. I'm just hovering my mouse.
Mm-hmm.
Moderate portfolio is 60 to 70% equity, 40 to 30% fixed income, like cash. Right? The reason I put bonds there, but you should not buy bonds. You should buy cash, or because money market is giving 5%, treasury bills is giving 5%. So just forget about the bond. Fixed income, growth 20%, 80-20 is growth. Aggressive growth is 100% equity based. So this is a good starting point. So how much risk can you take? If you want to be aggressive, go for growth, or aggressive growth if you want to be moderate. So first time, I'm talking about young people, they don't understand, start with moderate, but if you are close to retirement, we always recommend be between moderate and conservative. And if you're like someone young, let's say 50, and have about 30, 40 years to retire, you can be aggressive growth. But try to build up, Dr. Kohli, the portfolio in such a way you have some buying power. The mistake is if you be all 100% aggressive, market goes down, you don't have a buying power. So we recommend up to 20% some sort of fixed income. So the market goes down, you can buy something and try to like rebalance the portfolio. Market goes up, raise cash, market goes down, basically decrease cash. This is a better approach. So this is like a model I'm talking about in terms of the allocation, how a portfolio should look like.
So we are salivating when the market is done because they have so much cash now, they want to buy everything on the cheap. So that kind of strategy works for some people.
Yeah.
Anyway, Dr. Kedar wanted to ask, he raised the hand. Let me see if I can get him to talk. Dr. Kedar, are you able to talk? Go ahead and talk.
Yeah, he's muted.
Neither am I. But let's see what other questions we have here. There's a lot of questions still. Trust should include both husband and spouse, Dr. Sasapu. Naidu Sasapu. Trust should include both husband and spouse? Question mark.
Yeah, in a joint trust, I'm talking about you should have both husband and wife as a trustee, but depending on the situation. So from an asset protection point of view, I'm saying it that you can have two trusts, one who's like a non-spouse. You can have one trust for the non-spouse physician who is like a non-physician, I meant, and then the spouse who is like a physician, separate trust, two separate trusts. You can segregate the asset, it give you a little bit better asset protection if the spouse is non-physician. But if it's a joint trust, definitely both should be the trustee, both husband, wife's name should be there.
He asked me to read his question again. Let me see where it is. Anyway, I can't find it, but okay, Dr. J, naming one of our child as the financial power of attorney. What's your take on that?
Yeah, naming one of the child as a financial power of attorney is fine as long as the child is mature, is fine.
Right. Okay. Dr. Malhotra, again, for a person who has 7 to 8 millions in real estate, do you recommend creating a trust now as value of real estate will continue to rise in the future? Right. I guess the 7 and 8 million might become 20 million. So do you create a trust for that now? Why it's still not at the point of 24 million to 12 million?
Yeah, so someone who has real estate, in our opinion, that is a best way to gift it to an irrevocable trust, because what happened, real estate becomes discounted when you gift it to the trust. You can using a discount about 25% you can discount. So let's say you're gifting your real estate is 10 million. Because of discounting, the value goes down to 7 million. So still you have 3 million to gift more if you want to. And once you gift it, it grows estate tax free. And you can collect income from here, use it as long as one of the spouses is alive in SLAT. Definitely is one of the best way of doing it is gifted through a trust. Real estate, you should definitely do it.
5 minutes and 28 questions still. So let's see, I'll scan quickly and ask some of the questions who haven't been asked before. Dr. Satya Sudala, can you explain about tax status for having life insurance and explain the slide about 11 million again? I guess she's talking about
can you explain about tax status for having a life insurance and explain the slide about 11 million again? So basically she's asking the life insurance I spoke about. What do you mean by that? So let me just go back to the slide. So over here, I showed an example that let's say your net worth is 25 million and you have 4 million life insurance. All right. So for estate tax purpose, if you die, your net worth will be around close to 30 million. 25 plus 4 million, about 29 million I'm talking about, because the life insurance, there's no income tax, but it is part of your estate though. And if the total estate is more than 24 million, there is estate taxes due. It doesn't matter what comes into play. So that's what I meant by that. And then she's asking, can you explain what are you suggesting? So the next slide, what I suggested, listen, gifted 13 million from your net worth and life insurance, if you move it to a life insurance trust, and then the money is out of that death benefit is out of the state. So that's the way to handle it. That's what I was suggesting. So it will not be added into your overall calculation of your state. That's the way to do it. Hope it clarifies.
Interesting question. Please give some information about, quote, spendthrift trust for a grandchild with special needs.
Yeah, so a spendthrift trust basically, for child with special need. So you create basically a special need trust. It's a separate type of trust. If you have a child with special need, you can put the spendthrift trust clauses in a current trust, but we recommend if you have a child with special need, we suggest that have a separate revocable and irrevocable trust and have the spendthrift trust provisions there. It gives it the asset protection. The benefit is any government benefit comes, it is not part of the child's life, because anything more than $2,000 in the child's assets, the government benefit goes away. So yes, it is recommended to have all these clauses in a special need trust. You have to create separately if you have a child with special need. Yes.
Interesting question, probably helps a lot of people. Dr. Kota, can you tell us about tax loss harvesting and how does it work?
Yeah. So what basically happened that if you have, let's say, a stock like Amazon $10,000 gain, what you can do, you can sell this Amazon, but you have to pay taxes. Same way, if you have, let's say, a company called DocuSign, I'm giving an example, it is down $10,000. You don't think the stock will go up. What you can do, you can just sell DocuSign the $10,000, but buy something similar with the proceed. Now you have the $10,000 loss. Let's say you sell DocuSign and you decided to buy Bank of America, or you decided to buy something similar to DocuSign. I would say, let's say Apple, you decided to buy. Fine. Now Apple goes up, you will make money, but now you have the $10,000 tax negative. This $10,000 negative, any profit happen, you pay basically up to $10,000 is going to be a wash for you because you have the loss carrying forward. But if there's no profit, every year up to $3,000 you can claim from personal income tax, and it will keep getting carried forward. Number two. Number three, if you have a real estate capital loss, if you have a property, you actually book a loss, or sorry, a property have a profit, that could be offsetted against the tax loss harvesting you took it from the stock. So these are the three main advantage of tax loss harvesting. It's called harvesting, means like you sell something into a loss. If you're into profit, you pay no taxes. Any additional, any extra losses carry forward. That's what tax loss harvesting means.
Can you talk more about SLAT again, please? Mahendra, Dr. Mahendra asked that.
Yeah. So basically, we spoke about it, SLAT. So if in America, there's something called income tax, there's something called death tax, which is a state taxes north of 24 million. Is there any way you can gift it where I don't lose completely control over it? The only way to gift it is to an irrevocable trust. But the problem is when you gift it to an irrevocable trust, the money can be used for yourself. It needs to be used for the children. SLAT, Spousal Lifetime Access Trust, allows you, as long as one of the spouse is alive, you can the one spouse can take the money and use it for the other spouse. So that's called that's the provision is there. So that's why it is a better approach if you want to have some control, but still gift away. So as long as one of the spouses is alive, basically the spouse can take the money and give it to the other spouse, and they can use it for themselves if you want to indirectly. So that's why it's called Spousal Lifetime Access Trust. What happens to SLAT, irrevocable trust, after the death of the spouse? Unfortunately, what happened if the spouse pass away, her portion cannot be, because she's not there, right? So obviously she cannot take the money out. So it only works if both of the spouses are alive. So that's the caveat to it. That's the problem to it. So again, it's not 100% bulletproof. As long as both spouses are alive, or one of the spouses alive, the other spouse can take it and give it to the other spouse. That's the way it works.
Simple question. Probably the answer is also very simple. Tax write-off vehicle, is it available for salaried physicians too, or only for self-employed as business expense?
No, unfortunately, you need to have positive K1 to write this off, business income to write this off.
I am also doing locum tenens for, can one be self-employed and employed at the same time in the same year?
Yeah, no problem. You can be self-employed, employed, no problem. The 1099, you can do a S corporation, you can do a Schedule C, and you can have still the same deductions possible, no problem.
Or that you want to write off.
Yeah.
Right? Yeah.
Yes, on the 1099 portion, you write off everything, correct.
Right. If you have unused 529 money in your children's account, what is the best step or alternative to disperse that money?
Yeah, a couple of solutions there. Number one solution is that the money can be used for grandchild, higher education, use it for yourself if you're going back to school. Second option, Secure Act 2.0 passed. Up to 35,000 ballpark figure can be transferred into a Roth IRA for that unused portion for the child. So again, the option is available for the Roth IRA for the kid. The money grow tax-free. So if a lot of money, consider moving some money. As long as if there's some rules though you have to follow, like how long is the account is open and everything. But the Secure Act 2.0 allows you to convert the money to a Roth IRA without paying any penalty and everything. Worst come to worst, the unused money, you just basically take it out, the money, and you pay 10% taxes and 10% penalty and taxes on the gain portion only.
Chapter 905, Dr. Rambatla asked, irrevocable trust having only insurance to benefit children, is it a good idea or not?
Irrevocable trust for my understanding, if I understand correctly, that irrevocable trust
in that trust, insurance. Only
yes, it does. Yes, it is good to have it. Remember, if the net worth needs to be substantial to create a life insurance trust. Otherwise, I mean, if your net worth is smaller, let's say your net worth is 5 million, 1 million life insurance, no big deal. But if your net worth is 25 million, you have 10 million life insurance, move it to an irrevocable trust.
There's so many questions. Probably, Syed, you need to come back next year also under the new president to answer so many questions you have. Okay.
Yes.
Do you want to give any parting comments? I think we covered as much. I know there's still so much to be covered. So you spoke about estate planning, tax planning, investment management. So what is the financial advisor role? How do you make money, all that big money that you make, Syed?
Yeah, I would just conclude by some of the people ask that, can you give me some example? I want to buy some ETF. How does it look like? And again, don't implement it without talking to your financial advisor. So I'm just going to show you an example. If you want to buy large growth, I mean, you can Google yourself, start learning it. SPY is an ETF. VO is the mid cap, small cap. Large growth is QQQ, emerging market VWO. And again, this is just an example for you to learn it in this webinar. Do research by yourself, what percentage and assets should be. The slide is there in a balanced portfolio. All right. You can just try to implement yourself with as an ETF model. But again, don't do it without talking to a financial advisor. But this is a good starting point to start reading at how a model should look like. All right. And now, our role come into play, when we talk about financial planning, it is just not simply about investing or tax planning. It incorporates everything. It incorporates like tax planning, estate planning, life insurance, and you need someone who can pretty much like combine everything under one umbrella very efficiently. So we are a fiduciary financial advisor, and we take care of all of it under one umbrella very efficiently for our client. So we always recommend only use a financial advisor if you're just doing for investment, and if you're thinking the financial advisor will make you a lot of money. Beat the market is a mistake. The reason why you use a financial advisor for services on top of the investment as well. And we make money if you invest with us, and we charge a fee. Our usual fee is 1% per year to manage it. That's typically other advisor charge as well. Is an asset-based fee, 1% per year to manage it. We have a minimum investment requirement. Most good financial advisors usually have it. Is $500,000 to be our client. We charge 1% as a starting point. As the asset grows, the fees goes down. Let's say over $1 million, I'm giving an example, 0.8, over 2 million, 0.7. There's a range out there. So this is how a typical financial advisor makes money, but that includes all the consultation and everything we're talking about.
That go up with income. The fees go down with the assets. Huh? That's nice.
Yes, that's basically typically how it works. But as I mentioned, that only you need to have other needs besides just investment management to use like a fiduciary financial advisor. A lot of times people just think financial advisor will beat the market. They will be like they will make them like a millionaire by investing 100,000. That doesn't happen.
Not going to run any faster or better just because it's serviced by the dealer. It's still going to be the same. Anyway, Dr. Rangareddy, I think wanted to ask a question. Is unmuted. So go ahead, Dr. Rangareddy Garu. Because you're a past president, you have that privilege. Go ahead.
Can you hear me?
Yes, sir. We can hear you.
Yeah. Thank you, Ravi. First of all, this is just a comment and a simple question for Mr. Syed. Syed, I attended all your programs. It's a very educational and very informative.
Thank you.
Thank you very much. And my simple question is, I have been a resident of Illinois for almost 35 years. I signed up to be a Florida resident last year. Do you think I should upgrade my will? And if so, how much does it cost? You already answered, I think, but how much I need to do it in Florida?
Obviously, yeah. So obviously, so if the trust has been like, I'm assuming you did it recently in Illinois,
yes.
Right? Yeah. Yes. So remember, it's just one last page document. You just have to update that the Florida statutes prevail. And it's a recent update. So I'm not expecting a couple of $100. The attorney will charge more than that.
Yeah.
Just few hundred, couple of hundred.
I don't need to redo it then.
No, not at all. Remember, all trust works everywhere, just like just the statutes.
Okay. Thank you very much. And final comment is Ravi. And as you know, I chronicled the history of AAPI for almost 40 years. And I get to know all the presidents. And I can say this is a compliment. You are one of the most learned, articulate, and well-read presidents I come across. And thank you very much for your contributions to AAPI. And I wish you all the best for a very successful convention next week. And I'll see you there. Thank you, Ravi.
We blush. Probably you can see it. Anyway, thank you so much, Dr. Rangareddy Garu. You're one of my gurus and role models for being a passionate leader and advocate for members and AAPI and its role. And I really look forward to all of you being there at the AAPI convention. I know some of you have other engagements and obligations, but whoever still hasn't signed up, who are within the driving distance of Philadelphia, Northeast, please do join. We still have a few registration slots open. Hotel is sold out, but there are a lot of hotels around, so you can still find some place to stay, or you can stay with your friends. There are a lot of AAPI members around. So please come to the convention, July 6th to 9th in Philadelphia, and we'll have a great time. And again, I want to thank every and each one of you for being here and being so supportive through the entire year. I really enjoyed serving AAPI and all of you the best of my abilities, and with deep gratitude. And I really thank you, and I bow in gratitude. Thank you so much, Syed. Again, thank you so much for your contribution and your support. You've been a great
Thank you very much, Dr. Kolli. Looking forward to seeing you next week. Thank you very much for everything.
Thank you.
Thank
Sorry,
you.
Dr.
Bye-bye.
Kaiser, we couldn't get to you. Sorry.
Thank you.
Good night, and have a great day. And if I don't see you at July 4th, before July 4th at the convention, happy July 4th.
Happy July 4th.
Bye.
Bye-bye.